Hey there, this is Casey with the M&A Launchpad Podcast. Want to let you know about October 25th. Put it on your calendar. This is a do not miss one-day event. There's going to be incredible headliners, but really at the end of the day, you're going to get a chance to talk to people that have made acquisitions, learn from some of the challenges that they've made, because this is definitely a challenging process. But more importantly, there's going to be people there that can help you and support you along the way, from great vendors, quality of earnings, how to run the due diligence process, and how do I get financed? How do I raise capital? How do I structure all of these things? October 25th in Chicago, we're going to be gathering. It's going to be hundreds of people that are all focused, like-minded people. And man, everyone that's come has given us incredible feedback. So mark your calendar, October 25th in Chicago. We look forward to seeing you there.
All right. On today's episode, we interviewed Bryan Huber, where we did a deep dive into what a sale leaseback looks like. If you're out there looking to buy a business and there's a piece of real estate attached, right, it's not something to get scared of. It's really about, can you structure something that actually can make it a very, very valuable part of the transaction? So Casey, what were some of your takeaways?
You know, I've got a chance to meet Bryan personally. He's going to be sponsoring our Chicago event. I mean, just a great guy. But, you know, one of the cool things that you find in this sale leaseback world, which I'm relatively new to the conversation. If you're hearing it for the first time, don't be shocked. It's different, but there's a lot of different things that can happen inside of a deal. And as you're structuring a deal, and a lot of times we just kind of look at the real estate, put it to the side, and we go, okay, we'll just pay rent or we'll do these things. But if you start adding into your repertoire, you know, not only do I understand how this financing works, not only do I have this structure works, but now you've got another tool, which is called Sale Leaseback, which that Sale Leaseback opportunity can free up some capital. Instead of having to bring investors in, you can making it dilutive. You've got a vehicle to find some more cash. And so, man, to me, it's just a beautiful tool. I keep learning more about it because there's a lot of facets to it, but man, there's a lot to it.
No, agreed. And, you know, the Sale Leaseback, it's a little bit more of a complex tool, but it's a very, very powerful tool. So make sure if you're out there actively looking to buy businesses, that you understand it, because again, it could really turn some deals that may not, you know, pencil out into something that great and just home runs. And so lots of details on that in this episode.
Hey guys, go ahead and just pause the podcast for a second. When you're buying a business, you need to ensure the financial health of the company. The quality of earnings is mission critical. It doesn't matter what size business you're buying. Patrick O'Connell Advisory Group, they're dynamic. They do a great job. They're going to look over your shoulder. They're going to make sure that you're doing the right thing. And this guy's done over 200 buyers successfully, just like you. So reach out to him. And it's O'ConnellAdvisoryGroup.com. Click the link in our show notes. Can't live without them.
Hey, Bryan, welcome to the show.
Hey, Ferris, how are you?
I'm good. You know, just another day in paradise. So for those listeners today, right, we're going to talk about you and kind of your company and what does a sale leaseback look like. And so for the listeners, do you mind just giving people a brief overview on kind of yourself and the company?
Yes, of course. So I'm a partner with SAB Capital. We're headquartered in New York, and by trade, our organization is real estate brokerage, and what we specialize in is single tenant net leased assets. So that can come in the form of office, retail, and industrial properties. And the way we cover the marketplace is twofold. We work with real estate investors that are buying, selling, developing your traditional national tenants. So think Chick-fil-A, FedEx, 7-Eleven, McDonald's, very iconic, high grade investment class tenants. My side of the house, I lead the sale leaseback division. So I work specifically with companies that exist to make products, provide services, and or administer care. And often we're advising acquirers of operating companies and educating them on how they can use their acquisition candidates' real estate more effectively by improving the leasehold quality of the owned and leased properties, and using that as a source of acquisition financing. The sale leaseback asset category of net lease commercial real estate, you know, when I started in the industry, was an $18 billion market cap. Today, it's exploded to about 30 to 35 billion. So basically, there's a $30 billion demand stream of real estate investors that want to pay acquirers of companies to keep these tenants in their buildings, and that can be used as a source in place of traditional financing like SBA debt, equity, and other forms of traditional financing. So I'll pause there and field any questions that you have.
A million questions, I just want to say I've gotten to know you really well, Bryan. So, appreciate you joining us today. I will say, man, I was introduced to a sale leaseback probably about 18 months ago. I being an entrepreneur, acquisitions, all those great things. When you're in the SBA world and you're in some of the smaller SBA, SMB type loans, the sale leaseback isn't a conversation. But as we got into bigger acquisitions, we realized that this thing called a sale leaseback, right? It's an actual very viable tool that can help people out. So just in short terms for our listeners, let's just break it down really simple, right?
And really quick, just to add, right, to Casey's point, most listeners, if there's a piece of real estate involved in a business, one of two things happens. They figure out, how can I bake that into my SBA loan? And there is a path there if it's smaller. The alternative option is, man, this is too big. I can't buy the real estate. If the seller wants to sell the real estate, well, then you're kind of in a bind, right? But the sale leaseback is the tool to really unlock that. And so we'll kind of dive into that now.
Yeah, exactly. Or the alternative is, I'm an acquirer of companies, and I don't want my capital tied up in land and buildings because I want my assets exposed, my capital exposed to the operating company I'm buying based on multiple of cash flow. I want to improve that cash flow, and then I want to exit for a higher multiple than I paid. And, I think that's where we should probably start with, the sale leaseback vehicle and tool.
Yeah, let's break it down.
In commercial real estate, the language is cap rates. And in M&A, the language is multiples. And, the reason a sale leaseback can be an accretive strategy for financing and acquisition. Let's take a glazing business that we structured a sale leaseback for in 2022. It was a Dallas-based lower middle market private equity sponsor, add on to an existing platform, and this glazer did work for predominantly education, and this add-on was stained glass windows. So it provided them with an opportunity to enter, the religious market. So it was a small add-on, $5 million, came with, a 30,000 square foot building. And basically we used the tenancy and the lease commitment that the sponsor, was going to sign on for to finance the acquisition, where that the sale leaseback provider showed up at the closing table with $3 million. So basically, financing more than 50% of the add-on by just, signing a long-term lease and putting that in place in order for, the equity sponsor to not have to draw on debt or draw on equity or take on, incremental debt toward that platform.
Yeah, and actually, let me pause you there, right? Just to kind of really get our listeners around it. So the sale leaseback, what are you doing? You, as the acquirer, are selling that rights to that building to a institutional or quasi-institutional company through Bryan, right? And they are buying it and paying you based on the rents that you are paying. And what's the power here, right, is a couple things. It's a way to transact the real estate. So if you have a seller that wants to offload the business and the real estate, it gives you a path to sell it. But B, and more importantly, right, it's a way to not only get stability in the lease, but a way to convert your multiples on a business into real estate caps, right, which are much better. And so $1 in a business at a 4x multiple really can be converted into $10, $15 in a real estate valuation. And so it's a way to use that as a opportunity to get cash out in that process to then apply to buying the business. Right, Bryan, did I capture that succinctly as possible?
Precisely.
Yeah, and
So,
take the Glacier example. I mean, keep it. So the Glacier, right? Guy wants to buy. They want to buy an add-on. So they're going to buy an add-on business. Let's just say, what was it? $10 million.
$5 million purchase.
$5 million purchase.
five.
Did that include the real estate or didn't include the real estate?
That includes the real estate. They're paying, 3.5, 4 times. And then, we're able to monetize the real estate to a sale leaseback investor that's looking for a fixed income, return. And they're paying, a rent multiple, the inverse of the cap rate of, close to 10 to 12 times. So while, we are going to be encumbering the P&L with a little bit more fixed cost because we're able to monetize that asset at a higher multiple, this is an accretive avenue to finance acquisitions.
Yeah. So for every dollar you take off of the P&L, right, because your rent is going up, you're being given $12 immediately, so to speak, right? 10 to 12, kind of like you said, right? Whenever you do the inverse of the cap rate.
Precisely.
And that's the beauty of that arbitrage, right? Now they able to buy the company. They probably were able to get a loan for $3 million, not have to bring that additional equity to the table and purchase the new business, or they had the cash. They had $3 million in cash. They just didn't have $5 million. So they were able to use that lease back and make that acquisition.
Yes. Another example of this is, one we're working on right now in Pennsylvania. It's a business, Casey, I think you'll appreciate this because the profile of the business owners, 2 70-year-old gentlemen that have been in business together 40 years, been in this building for 30, do about, 10 million of revenue and, consistently like, 1.5 million of EBITDA. And, the equity sponsor that's purchasing this business, the way they've been able to structure it, it's about a $9 to $10 million buyout, 4 million of SBA debt, 2 million of seller note, and then the sale leaseback is going to contribute about high 2 million, 3 million. So for first time business buyers that don't have a lot of resources or don't want to take on the dilution of equity partners, this was an accretive strategy, to use the real estate, offer a lease on it, and have it contribute toward the capital stack.
And Bryan, do you think that that's where SAB and what you guys do kind of makes y'all so special, which is, the normal, like when I was introduced to Sale Leaseback, it's almost like, hey, it's got to fit this box. It's got to look like this. It's got to have this much EBITDA. It's got to have this. Do you guys just kind of are you really flexible in regards to getting these done, have unique ways to get it done? Because it sounds like what you're talking about right there, right? It's 10 million revenue business. It's not some unbelievably, large business that you have to go to some massive institution to maybe buy these leases, but you're able to help that person get that $10 million business done because you guys you just got to be real creative, right? You got to be able to find those partners that are willing to take that lease.
Yes. So I think, what differentiates SAB in the marketplace, relative to other sale leaseback placement advisors is that, we've adopted an approach where we're true transaction professionals. And, I often like to relate it to, the quality of earnings report, right? A Q of E. Why would you not be diligencing your acquisition targets, owned and leased properties to the same standard? And, what we're doing, on a pre-LOI basis is, taking a look beneath the hood, seeing what rents are in the submarket, and making a recommendation on how much the business can support, but also what's geographically replaceable. And I think what's unique about where we sit, being in New York and having access to private investors in 1031 exchanges that often the options that they're looking at are investment grade tenants. Think of the 7-Elevens, McDonald's that I referenced earlier, and the cap rate yields on those are super compressed. Call it 4 to 6%. So for those private investors that are looking for a little bit more yield to diversify with their portfolio, we have a dedicated 1031 placement team at SAB that my business partner, Michael Scally, runs. And that's all he does. He works with first-time triple net lease buyers and educates them on the different fruits, flavors, and categories of properties, geographies, but most importantly, the credit composition of the entity guaranteeing the lease. And for investors that are buying multiple properties, sure, they might buy that McDonald's at a 4 cap to have that stability and that reliable rent roll. But they might also want to add some yield to that portfolio. So where we've been effective on some of these smaller SMB transactions is bringing that category of sale leaseback providers to these properties' doorsteps and minimizing the execution risk and providing more certainty and maximizing value.
So maybe let's ask some questions around it, right? So have you done the holy grail of sale leaseback, which is I'm a buyer, I find a business, and I essentially agree to buy the real estate and the business from the owner, but get it 100% financed through the sale leaseback and essentially buy the business for close to $0?
It's a really great question. Yes and no. No, in the context that in a platform investment, that's very challenging to pull off, because if the acquirer does not have any quote unquote skin in the game, any of their capital at risk, basically what you're asking the sale leaseback provider to do is to take on equity like risk with upside without any upside. Their upside is capped at the lease stream that they will be collecting over the course of their ownership of that property. So often the sale leaseback investors don't like to take on that level of risk because they don't, your landlord is not an equity partner. Your landlord is not a lender. So they don't have any control over, the operating assets and the ability to dictate and mitigate the success of that tenant and that organization. So I think, that's one of the beauties of the sale leaseback tool. It's, you're, like I said, your landlord's not your equity partner. And a lease doesn't have covenants that, a loan would typically require. And usually it doesn't require personal guarantees or personal recourse. But in the instances where, sponsors putting no equity in the transaction and all, that's challenging. However, we have been able to successfully do that with add-on acquisitions. So for instance,
got it.
Yeah. There's an existing lease guarantee and platform that we can leverage, and that platform is able to bolt on a smaller business for say $5 million, and we're able to make sense of the rent and cap rate scheme for $5 million. That's where we're able to fund 100% of add-on acquisitions. But the sale leaseback provider is often going to want to see that there's a meaningful equity contribution in that platform, and they're comfortable with that risk because they're not just getting the lease guarantee of that small business that's getting added on to the platform. They're getting the platform level guarantee, so there's more diversified exposure on their ability to collect rent.
Got it. So maybe let's dive into that a little bit then. What is the smallest sale leaseback that can be done? And I don't know if that's in terms of purchase price of the business of the real estate, or is it in revenue on the business? It's kind of conversation that Casey and I actually had a couple of days ago. And so what do you guys look at in terms of size, or maybe your institutional buyers, right? Like, is there a size limit? Because I'm thinking, some of our listeners, they're searchers. They're maybe looking at, a business that does $3 million of revenue and maybe owns a $750,000 piece of real estate. Is that something that is sale leasebackable, right? And kind of how do you guys look at that?
Sure. So I would say it depends on geographic density and property category, right? So why I think that's important geographic density, like if that building is in Wadley, Alabama, versus Lakeland, Florida, the ability for that landlord to take on that risk and retenant that space in the event that the legacy tenant that they're doing the sale leaseback with defaults for whatever reason. The probability of reletting that space is much higher in Lakeland. So thinking back, early in my career, there was a small add-on that we did actually in Lakeland, Florida. It was for like an IT service business, and they did, back office, had a small data center, so 30, very, very, very small, like 3,000 square foot office condo. So that we did that transaction. It was like a $750,000 sale leaseback back in 2018, 2019. So I would say, geographic density played a role there because if you got the building back, there's tenants that will be knocking on your door to lease the space. And then also plate size, right? So that's why I said earlier, we have to think about, office, industrial versus retail, office, single tenant office. So I'm not talking about professional office, high rise office like in Dallas or New York, but medical office buildings, daycare centers, autism clinics that, span, call it 3,000 to, maybe 20,000 square feet of single tenant, single story freestanding space. The price points on those transactions, will more likely range in the $1 to $3 million domain because we just don't have the square footage to spread the rent around. Whereas, with industrial properties, when we're talking about 50 to, 500,000 square feet, there's a lot more rent to allocate across that footprint. So that's where the price points get bigger. So what I would say to answer your question for industrial, it's probably about $2.5 million. For office and retail, it's probably about $1 million with the, asterisk depending on geographic density.
And does it also depends on the business itself too, right? There's almost like multiple layers, right? So you say, okay, $1 million on, single office, single tenant type office. However, the business also has to be able to not only support today's rent, but it's got to have a business plan to keep up because that rent goes up 2.5%, 3% every single year. So you've got to also be able to support that. So I imagine there's another component to it other than just the real estate.
Yeah, no, Casey, great question. And I'm glad you're bringing it up because I would say like the three commandments to underwriting any sale leaseback boil down to three variables. Number one, the credit composition of the entity guaranteeing the lease. So like how much revenue and EBITDA does the business do? Number two is going to be the lease structure. So is it a 10-year term, a 15-year term, a 20-year term? The longer the length of the lease commitment and the escalation structures that you're talking about, like, are they 2%, 3%? Are they CPI? So how am I protected against inflation as the landlord? And then, number three is the real estate. Like where's the business located? And what corner is it on in that submarket? I would say like that third variable is usually the least important because, when a sale leaseback investor is signing a 15 or 20-year lease, like that's a bet on the tenancy. So often, what they're doing to underwrite and mitigate that risk and what we're underwriting for, when we're working with acquirers to help them, to help prepare indications on how they can incorporate this into their underwriting to help finance the purchase of the operating assets. We're looking at the history of the tenant in that building, what is housed in that building, what type of equipment, machinery, where the customer is located, where the vendor is located, what's their proximity to the headquarters here, the property in question. And, all of those variables, play a a critical role in scoring how much rent we can actually spread across that plant, because it's a balancing act. Because what we don't want to do is make a recommendation on rent that is going to choke the business, because then that's a lose-lose for the landlord and the operator of that company. So we want to make sure that we find a responsible and palatable rent that is accretive enough, for it to achieve the proceeds that we're looking for relative to the owner's expectations on what they think the property might be worth, to make that 2 + 2 = 6.
Yeah, exactly. And to sum it up, really, I mean, you're evaluating the credit worthiness of the tenant, right? And credit worthiness means ability to pay and free cash flow and all the above, right? And for those that are buying real estate, just like whenever you get a loan, they're typically looking at, how much free cash is there to pay the loan and how much buffer there is, right? That's what DSCR, debt service coverage ratio, and they want to see a 1.2 on the DSCR. Well, similarly, in this scenario, you're not taking out a loan, you're paying rent, right? The leaseor wants to make sure the leasee can pay their rent. And if the business slows down a little bit, they still have enough buffer to pay their rent. And so there's only a certain amount of rent that any business can absorb, right? It's not like you can make it infinite rent. And so it's really evaluating that to get to the right amount of valuation on the real estate, because it's all tied, right? The rent is tied to the value of the real estate, which is tied to how much cash out you can take out. And so for anyone looking to do this strategy, you have to really weigh those. And that's where you pull in a Bryan, right? And you work with a Bryan and say, hey, here's what it looks like. Can you please educate me on what you think rents can be achieved? And Bryan, you're going to turn around and look at, okay, what's the real estate? Well, let's talk about the business, because that's actually very much part of the equation to get to a number that makes sense. And then as a buyer, you can figure out, is this something you can economically live with, right? You're increasing rents, which increases your cost, but you're getting cash. And how do you weigh those two things?
Yeah, and I'll even add one of the other things that adds to what you're saying, Ferris, is that it also doesn't count against when you go to a lender and they look at it as a lien or another covenant, right? It might count against debt service, but it's not going to affect your ability to borrow more money in the future, because it doesn't have that kind of, like, I took a second loan to get $500,000. Well, I sell leaseback, it just increases my rent, but I can still go get that $500,000 if I need it.
Yeah, no, it's I like Casey. I like the question that you have. How does this impact my relationship with the lenders and the financeability of the operating assets if we're not including the property as part of that collateral pool? And the reason an acquirer of a company may look to utilize the sale leaseback over having that sit in the collateral pool from an SBA lender or a more traditional lender is because often, the way a bank underwrites the value of a property is based on its appraised or intrinsic value. So an appraiser will go out, study the submarket, assess, where similar, office, retail, industrial, whatever the subject category is, are trading on a price per foot in that submarket. And what they're not going to do is really study the performance of the tenant, how long they've been in the building, how much rent they can actually support. So when a lender extends financing and has the real estate in the collateral package, it's based on an appraised value and not a sale leaseback value. So I would say the general experience that we've had in the marketplace is that there's a variance of 1.5 to 3x between appraised value and leaseback value, and why the leaseback investors are prepared to pay a higher price is because of the income that's being sold, with the building. At the end of the day, what a sale leaseback is, it's bonded real estate. It's a fixed income vehicle. It's depreciable private credit, if you will. So the relative to extending a loan to an operating company like this, owning their real estate, you have the ability to depreciate that asset, and you have a collateral interest in the building. but you are also unsecured in the operating assets. So, the sale leaseback tool really sits between senior debt and mezzanine debt.
I love it. So what happens at the end of the lease? So we get to the end of 20 years. Do you have the option to buy it back? How does that term usually roll out?
I hope the acquirer that we're supporting is not there in 20 years and it's someone else's problem to figure out, right? Because if they're holding this for 20 years, they didn't execute on their investment thesis. The goal is to, build the business, grow that cash flow stream, and then exit for more. No, but all kidding aside, usually at the end of the lease term, and the end of the base lease term. So if the initial is 10 years or 15 years, structurally into the lease, there's usually extension options built in the form of like 4 or 5 year renewal options, or sometimes we see 3 10-year renewal options. And, that's unilateral in favor of the tenant. So the tenant can evaluate, hey, I want to continue occupying this space. And it's usually at a fixed rate, based on the increased structure that was agreed to over the base term, which can be valuable, maybe not valuable. It depends how the submarket rent grew over the life of that lease. But there's usually, not a structural buyback option at the end of the lease term because of some of the complications that can create with the lease accounting.
Got it. And this last question, because that's actually something we were wondering. In a sale leaseback, is it hard to negotiate for the business, right? The buyer to basically say, hey, at any point in time, we have the right to buy it at a, 5 cap, something expensive to where it gives the seller, they're not concerned like, hey, am I undervaluing my real estate? But it gives the potential next acquirer the comfort or the confidence knowing, hey, I could also buy the real estate. Because some businesses are so deeply integral to the real estate. Like you may not be able to get the environmental permissions that you got the first time around, right? Things like that. And so is there a way to structure it to help mitigate that risk for the next buyer?
Yeah. So I would say, you certainly have to pay for that purchase optionality, like to your point, at a much more compressed cap rate than the original sale leaseback investor acquired at. But having that purchase option in the lease, like I said earlier, can create accounting issues and tax issues for both the landlord and the tenant. That everyone should consult a tax advisor.
What you're saying is it becomes a finance lease. And so now it almost might have to be amortized and look differently. So now it could go against your debt covenants and all the advantages that you're getting from the lease.
Yes, the goal often is to structure the lease as an operating lease, and by including that purchase option, there's a case to be made that it's more of a finance or capital lease. We could do a whole podcast segment on that, and it'd probably be super boring and granular. But general rule of thumb, if these landlords that are providing this sale leaseback capital, to answer Ferris's question, because they're signing up for this long-term lease, they have a vested interest in, seeing the net worth of that tenant grow. So, if the original acquirer of that business is getting ready to exit, and they're going to exit to, a larger, let's say strategic or private equity sponsor with an existing platform in that space, they're going to realize a credit enhancement, and that's, in the landlord's best interest, because if they invested at, a 7.5%, 8.5% cap rate, and then someone's going to come in and, buy the real estate at a 5 on the then rent, or assign that lease with, a higher net worth lease guarantor or tenant, that's going to improve the value of that landlord's property.
Got it.
All right, cool.
Huge, man. This is good stuff, Bryan. Yeah, thank you for spending some time with us here. Let's jump into some of the other meat of the
I completely agree. I mean, Leaseback, valuable piece of information. But for now, we can hop on to our rock around where we ask our guests the same 3 questions. First question, what do you like to do in your free time?
So I grew up playing hockey, lacrosse, and as a result of playing those sports where requires a lot of conditioning, strength training and endurance training has always been a big part of my fitness routine. So I like to compete in races. So not running marathons where you're aimlessly running for 26 miles. I think that gets pretty boring. But dynamic races, like I competed in a high rocks competition in New York, June 24 and then 25, which is basically 1,000-meter runs 8 times, and in between each 1,000-meter run, you're doing some form of a dynamic or functional exercise: skiing machine, rowing machine, farmer's carry.
Cool.
Walking lunges, wall ball, squats. So I like getting out there to compete. And
what was that race called? What was it called?
High Rocks. It's a European race. My uncle introduced me to it at the end of 23, and I was looking for something to do other than compete for Sale Leaseback business. He put this on my radar, and Michael Soleimani and I, one of the other partners at SAB, competed together in 24, and then Preet Sabharwal and I competed together in 2025.
That's awesome, man. All right, next question. What's your most memorable moment in your business journey?
Most memorable moment in my business journey really goes way back to probably 2008-9. I'd gotten a snowblower for Christmas from my grandfather. He really introduced me to power tools, and my brother and I started this snow removal company, Huber Snow Removal, and we had a neighbor that wasn't really valuing the service that we had performed timely, and thought we were overcharging, and thought do something neighborly, like we're not gonna pay you for this, but we had to have a hard conversation and communicate to them, no, like this is a business for us. This is how I'm paying for gas money for the car that I'm gonna get when I'm 17. So having that hard conversation and being able to professionally articulate that, hey, people are giving me a commitment to basically clear the snow in their driveways, and I can't prioritize service to you if you're not prepared to to pay us. So my dad at that point, the thing that sticks out is don't be afraid to ask for what you're worth.
Love it.
Cool.
Good stuff.
All right, and the last question: favorite tool or resource?
A mechanical pencil and a calendar. It's something I've done for 15 years now, since I was a freshman in college at University of Delaware. I sit down every Sunday night and just roadmap my week, and that pen and paper, pencil and paper, specifically pencil, because writing that down creates intention and provides you with the clarity to prioritize and deprioritize the 3 or 4 activities that we're responsible for and the tasks that need to get completed on said week. But things have a tendency to change all the time, so that's why I say pencil, because having that roadmap provides the visibility and clarity, but often you have to erase, re-erase, and move things around. But very old school approach to organization, but it's something that's worked for me a long time, and creates the consistency that I need to perform.
It's huge, man. I'm similar, man. I got a calendar, got a pen. I don't have a pencil, but sometimes just whatever's on the desk. But I too, I like to roadmap. I like to draw it out, look at it at the end of the week. Man, it helps me out so much. My son, when he went to college, it was the same thing I told him. I was like, you got to map it. You got to have a plan. You got to know what you're going to do every week. And hopefully he's doing what he says. So we'll see. But Bryan, man, just really, really awesome to hang out with you today and learn more about Sale Leaseback and about SAB. If our listeners want to get a hold of you, how's the best way to contact you?
Yes. So, my full name is actually John Bryan Huber. My dad is also John Huber. So my entire life, I've gone by Bryan just to avoid confusion around the household growing up. And that's me on LinkedIn, John Bryan Huber. And you can refer to me and reach out to me and address me as Bryan. My email is bhuber@sabcap.com.
And we'll put down the show notes for the listeners. Awesome. Well, Bryan, thank you very much for educating our listeners on the Sale Leaseback.
Yeah, thanks for the opportunity, and awesome to spend some time with both of you, and look forward to getting together in Chicago here in the next couple of weeks.
Absolutely. Looking forward to it.
Awesome.
Thanks, Bryan. Thank you for listening to the M&A Launchpad Podcast. If you've enjoyed today's podcast and would like to support us, please leave us a rating and a review after you listen. I'm Casey Minshew, and I look forward to talking with you next week.